Good evening, YouTube. You guys heavily requested on TikTok that I go ahead and talk to you guys about options trading. So, given that I'm currently hunkered down, about to get hit by a blizzard, I figured that now is as good of a time as any to go ahead and cover that. So, thanks for joining. Full disclosure, I am not a financial advisor. So, this is not investment advice. This is for entertainment and educational purposes only. So, when it comes to options, they're pretty complicated and they're very risky. So for new investors, they really aren't a great option. I'm just being honest with you guys. If you plan on trading options, make sure that you read up extensively on them and that you have some experience trading before you do it. That said, I'm going to go ahead and give you a general overview of a few types of options trading. Option trading can get very complicated very quickly. We're going to focus specifically on puts and calls, and that's it. There's a lot more to it, but we're just starting. We don't need to bite off more than we can chew right now. So those are going to be the two things that we're going to be talking about tonight. So when you buy a call option, it gives you the right, but not the obligation, to purchase 100 shares at a set price, known as the strike price, at a set time, which is known as the expiration date. So let's say that I turn this YouTube channel into a company and that company is publicly traded. So Lo-Fi Finance, we'll say, is currently trading at $25 per share, but you've done your research and you have reason to believe that it could go up to $50 in the next couple months, maybe even a little higher. So you buy a call option. The strike price is $35, the expiration date is November 1st, and the cost per share is $3. So that means that you are paying a total of $300 for your contract, because remember, $3 per share and 100 shares per contract. So it's November 1st, and Lo-Fi is now trading at $50 per share. You were spot on, and you've got two options. So your first option is going to be to exercise your contract and purchase 100 shares for $35 per share. So in the long run, that's going to save you $1,500 because you are buying these below the current asking price. This is a really good option if this is a company you believe in and you plan on holding Lo-Fi shares for a considerable amount of time. The other option, if you either don't have the capital to do it or you just don't want to deal with having that many shares in that company, would just be to sell your contract. And you would be able to sell that for $15 per share and make a pretty considerable profit. But if we're wrong and Lo-Fi is trading below the strike price by the expiration date, then that contract is going to expire and it's going to be worthless. So that $300 we invested, gone. So your risk is limited in this sense because you can only lose the $300 that we put in, but our profit is technically speaking going to be unlimited because we could be wrong in the sense that it actually goes higher than $50. It could go to $60, $70, $80, or $90, in which case we make even more money off of this deal. So that's why call options are so attractive, but they're risky because at least if we're wrong with stocks and I bought stocks for $300 and they go down in value, there's still some value there. I can sell them, it'll be at a loss, but I'll at least get some of that money back. But with a call option, if I'm incorrect, that money is gone. There's no getting it back. I lost it. But if I'm right, then I could make a pretty significant amount of money. So just make sure that you're always doing your research before you're doing anything like this, investing in general, but with call options in particular, you really need to make sure that you have a solid theory that is going to be backed by data and research to support why you believe that this is worth doing. So with put options, it's going to be the opposite of a call. So this is a situation where you believe that the price of the stock is actually going to go down. So we'll say that Lo-Fi is trading at $30, but you think it's going to drop down to 20 or maybe a little lower. So your put is going to allow you to sell 100 shares at a set price at a set time. So let's say you buy a $20 strike price put for $3 per share. You're going to be investing another $300 because we did $300 with the call. Now we're doing $300 with the put. So it's November 1st, and Lo-Fi is now trading at $15 per share. Since Lo-Fi is trading $5 below the $20 strike price, you have made a gain of $5, and you've got two options. First option is you can exercise, and you can sell the shares that you currently hold for $5 above the market price, or you can sell the contract itself, which in this situation would get you a $200 profit. But let's say you're wrong and lo-fi is trading above the strike price by the expiration date and the contract expires. Just like with a call option, this contract expires worthless. You do not get your money back. Your risk is going to be limited by what you invested, but your profit is also limited in this instance because the stock price can't go below zero. So your chance for profit is somewhat diminished with put options when compared to call options. But again, just like with calls and just like with any other sort of investment, make sure that you do your research and make sure that you have a solid reason for why you're doing the investments you're doing. Only advanced investors should really trade like this, though, because you could lose a good bit of money. You could make a good bit of money, but you're having to front a significant amount of capital in order to possibly post that profit. You're risking a loss of significant capital if you lose. And let's say you're right. Do you have the capital to then go and exercise and to buy all 100 shares? If you're new to investing, probably not. So that's one of the reasons that doing trades like this really should be done when you have the capital to back it up and you have the experience trading to know what you're doing. Make sure that you do significant amounts of research when you're doing this. Very, very important. This isn't just something you do on a whim. This is something that needs to be done because you have data to support why you believe that this stock is going to go up in price. Other forms of options trading exist, but these are kind of the two fundamental forms. And since this is an introductory video, I think we should go ahead and call it a night right here. Remember, do your research and do not invest more than you can afford to lose. I've got some links in the description of this video. I've got a link to my Redbubble account where you can purchase laptop stickers, t-shirts. I've got some hoodies on there, just if you want to go ahead and support the channel. I've also got links to my TikTok and to my Instagram. I really appreciate you guys watching. Leave a comment saying what you'd like me to cover next, and happy trading.